Market starting off September on a sour note. The major averages near the lows of the day as we speak. Our next guest, though, says this is a buyable dip for stocks. Let's bring in Warren Pies of 3Fourteen Research. Welcome back. It's good to see you.
Nice to be here.
What makes you think that?
Well, I think that today is really about, and really what we're going to hear a lot about over the next couple months are these headline risks, which everyone's familiar with. I mean, I feel like I've listened to the last, hour of programming, and everybody says the same thing, which I agree with. The next 8 weeks are kind of a tough period of time. Seasonal September, the last 4 September has been down. Obviously, the election's a big deal. Fed cuts, nervousness around the economy. I think that those are the optical reasons to be afraid. But in truth, I think the equation of the market has simplified here in recent weeks. And so basically it comes down to, are we going into a recession? Is the economy going into a recession or not? If we're not going into a recession, I think you look for this weak opportunity seasonally to buy in if you're underweight. You have an offensive mindset. And if you think for some reason that the economy is going to a recession, then obviously you need to play defense. But that's our view, is that we're not going into recession. Weakness should be bought.
What if we agree with you? Okay, we say, okay, I agree with that view. We're not going into a recession, but because I don't think Adam Parker necessarily thinks that either. But earnings expectations going forward can still be too optimistic, even in that environment. Wouldn't you agree?
Yeah, I mean, I think there is a decent amount priced in, and we've seen that consistently over these years, where you get kind of a bolus of earnings out into the future, that of growth priced in, and then each quarter you go through, and the companies have to kind of either talk you up or down. And what we've seen, though, is that as we've come through, really we've seen a hockey stick up in earnings here, and yeah, the expectations were high, but they've largely been met. And if under a soft landing scenario, if you think the Fed's going to cut and the Fed's going to support this economy, then I think those earnings estimates, while they're aggressive, I think odds are that we hit those outside of a recession.
I just want to note that as we're speaking here, the Dow is now down by 700. So we're at the lows of the session as we begin September, which we know, as you said, is a seasonally bad time for stocks. What areas of the market would you lean into in the midst of this low of the day weakness?
Right. Well, I think it's kind of a process of elimination. So number one, we're late cycle. Even though I think that the soft landing is the base case and we avoid a recession, I mean, obviously the risk you have to control for is that the economy is weaker than we anticipate. And so I've seen a lot of people go to a low quality playbook, or kind of an early cycle playbook, which I still don't get. So we saw like the big small cap rally in July. We have been fading that. So I would avoid small caps, avoid cyclicals. I think for right now in this period, going into the first Fed cut, I'd expect the 10-year to fall further in yield. So I think you get this rate sensitivity leadership to continue. And as you get days like this where high quality tech is selling off, I think you're buying that dip in high quality tech. So avoid low quality, lean into high quality. That would be the playbook for a late cycle market like this.